Okay, hi everyone. This is going to be the problem video for chapter 10. A lot of this is very kind of consistent with what we saw in the PowerPoint. So it looks like we have a lot of problems here. Some are going to be quick, some are going to be longer. So let's kind of work our way through this information on it. Okay, so we're starting here. We have a company, they purchased some new equipment and they made the following expenditures, right? There's the purchase price, sales tax, freight charges, so it's like shipping, insurance for the first year, right? And then installation of equipment. So this insurance isn't like while it's in transit. Instead, it's for like the first year we own the thing. They want to know here, and it says at the bottom, the equipment, including sales tax, was purchased on an open account within the last 30 days. The other expenditures were paid in cash. Prepare the necessary journal entry for the above expenditures. Okay, so the idea here is we said, right, that general rule, all of the costs, right, up until you flip the on switch, right, you place this thing in service, are going to be capitalized, right? Thereafter, if you throw money into this thing, right, we'll, kind of talk about this in your more advanced classes. The general rule is you're going to expense it afterwards. If it's a capitalized improvement, you can capitalize it, but general rule is if you throw money into it afterwards, you're going to expense it. Okay, so when we look at what's going on here, right, the journal entry, right, is going to be essentially debit equipment, credit account payable, credit cash in this situation. Now, for the equipment, right, it's going to be the purchase price, the sales tax, the freight charges, and the installation, right? All of those costs up until we flip the on switch. So if we do like an equals 45,000 plus 2,200 plus 700 plus 1,000. There we go, 48,900. It says, the equipment was purchased on open account, right? So that's going to trigger open account, right? An account payable in this case. And it says the remainder was paid in cash, right? So if we think about this, let's look at it. The equipment, so the purchase price. So if we were to do basically, in this case, right, the equipment was purchased on account and the rest was paid in cash. A little bit, it's not like super obvious there, like how they define that. But right, if you take the 45,000 plus the 2,200, right, you get 47,200. So we can then back into 1,700 for the cash, right? So that will deal with, everything there except, right, we kind of have this mystery insurance on the equipment for the first year, right? So that's kind of something up here. We said the general rule, you're going to expense it, but this is prepaid insurance, right? So because it's prepaid insurance, we have to capitalize it. So we'll do debit, prepaid insurance, credit cash, okay? And that's going to be for what? 900 bucks, 900 bucks, okay? So you can see the green guys. Afterwards, you throw money into it. General rule is expense, but you could capitalize it, right? It depends what the expense is. Here, we just happen to be capitalizing it. All of the other items, up until we flip the on switch, the blue guys, right, those are going to be capitalized. Not too hard there. The only kind of tricky thing is reading the verbiage. Okay, let's check out 10.5. We have a fitness company and they made the following cash purchases. So essentially what's going on here is they got a patent for a workout equipment, right? We'll just call it like a Bowflex. They then enter into a franchise agreement with a gym, right, where I guess they're going to use this Bowflex, right, a 3-year agreement. And then they have the exclusive right to sell a book, right? So this is going to be a copyright, okay? Just kind of giving you the lay of the land here before we look at the specifics on it. Prepare the summary journal entry to record the expenditures related to the initial acquisition. So we have some intangibles here. Let's start with looking at it, right? So they get the patent. Essentially, they buy the patent here for the Bowflex, right? They made the following cash purchases. The Bowflex they get for $200,000. They created a unique design for the equipment. They also paid $10,000 in legal fees, right? So for that patent, right, what we're going to have there, right, with journal entry, we bought a patent, debit, patent. It's going to be for the $200,000 that we paid plus the $10,000, right? The attorney fees, right? Up until we kind of use that thing, all of the money we throw into it, we're going to capitalize. Put a check mark there, not too bad. All right, for the franchise, right? We paid $300,000 for a 3-year agreement. That's great. It has locations throughout the country. And then we're going to have an additional fee of $5,000 for each month. It operates under the gym name with payments beginning in 2024. And then it also looks like we bought some equipment, right? Some exercise equipment. So let me put that equipment over here as well. All right. With the franchise, right? We're going to do debit franchise. This is just going to be for the $300,000. Okay, we're going to, at least right now, ignore that $5,000, right? That guy right there, that monthly thing. What we'll do with that is, right, we will expense that $5,000 as we incur it. We're not going to capitalize that as part of the franchise, right? Then we have the equipment, right? So we're going to do debit equipment, right? That's a tangible asset. So I don't know, we could just say we made that blue. Sorry, I'm having trouble there spelling equipment. That's $400,000. That's great. You can put a check mark next to these guys. All right, then the copyright, we paid $25,000 for this thing, right? It has healthy recipes. That's great. Be healthy. We paid 25 grand. So we will do debit copyright of 25,000. And let me just, I'll put the comma there. What the hell? And then let me get all these guys, because this is the accountant in. I don't want to have this all formatted the same with commas, otherwise it'll drive me nuts. And then we'll have, in this case, credit cash for that entire shoot and match, right? All of these guys, right? 935. So what's going on here, right? What's kind of the lesson of this? We bought a tangible asset. There we go. We got 3 intangible assets, a patent. We bought it, all of the costs up until we kind of, flip the on switch on it. We start using it. That's going to be what we paid, plus, hey, the attorney fees. The franchise, what we paid for it. The ongoing fee with that, we don't do anything with, right? I mean, later on, we'll expense it as we incur it, but right here, when we're figuring out acquisition costs, it isn't part of the patent. And then the copyright, easy peasy there, 25 grand, that's what we paid for it. So this would be kind of that journal entry you would do for the summary journal entry on there. All right, we got another one coming up, right? This is a lot of fun, right? We have, it looks like one corporation acquired all the outstanding stock of Corporation 2, right? So we have Corporation 1 who is buying Corporation 2, all the stock, right? And it looks like they paid what they gave was 11 mil, right? That's great. What did they get? Right, they gave and they got, accounts receivable, land, equipment, patent, accounts payable, a liability there. So they got some assets and a liability. They want to know what is the amount of goodwill, right? Well, we said as a general rule, you're only going to see goodwill in this kind of situation where one corporation is acquiring another. Internally generated goodwill, kind of too speculative to put that on the balance sheet. Here we meet that criteria. What we do, right, is we compare what we gave with what we got, right? We will ignore book value in this case, right? This is what C2 had it on their books for. We ignore that. If we were to just do the math on this, right, the fair value of what we gave, 11 million, that's great, right? Then we gotta have to do the fair value of the net that we got. Right, that's kind of weird. What do we mean by net that we got here, right? So it'll be the fair value of the assets that we got minus the fair value of the liabilities, right? We get the good and the bad with them. So these guys right here are the fair value of the assets, right? It's going to be 11,700,000 if you were to total these guys, okay? The liability, all right, we take the good with the bad. When we buy this, right, that was good, we got assets, but we also take on these liabilities. Right, so that's what we gave, 11 million. That's what we got, kind of the net of it, of stuff. Right, what I mean by stuff is like physical stuff. So the difference there, right, the 1 mil, that's going to be the goodwill, right? It's not the store goodwill, it's goodwill, like the favorable reputation, right? How we kind of quantify this, one business buying another. You could do the journal entry for this, right? They want you to do, the journal entry. All you would do is debit all of those assets for the fair value, right? You would credit the liability for the fair value, and then you would hit the difference, right? The plug in this case would be debit goodwill for the 1 million, right? That's kind of the plug, right? You could do it as a journal entry if you wanted to. Not a big deal there. All right, let's look at 10.8. It looks like a company here purchased 2 buildings. That's great. They had a lump sum price of 900 grand, right? So essentially this is a basket purchase, right? If it's a basket, right, they got building 1 and they got building 2. And for this thing, they paid 900 grand, okay? It's like a bundle, right? They bundled it. Now you don't just put like debit basket on the balance sheet, right? You got to break these things out, the 1 and the 2 there, right? You need to have like debit, building 1, debit building 2, okay? How do we do this? Right, well, they then tell us the fair value of the buildings were 450 for A, and 250 for B. Right, so if we have 450, so let's just make like a fair value column, building A, 250 for building B, and let's see what else they tell us here. Also, there was $300,000 for the land, right? So there must have been some land in here as well. All right, here's the deal, right? If you were to just sum these guys, right? 450 plus, let me move it up. 450 plus 250 plus 300, right? You can see it's, 1,000 total. So if we were to get the percentage on this of total fair value, this isn't that bad, right? It's basically, hey, 450 divided by 1,000, 45%. 250 divided by 1,000, 300 divided by 1,000. You add those guys up, it's 100%, right? So let me put these kind of in percentage signs here, 45, 25, 30. All right, now what we do, right? We paid, what did they tell us here for this? 900 grand for this thing, right? 900 grand, 900 grand, 900 grand, right? What we paid. So to figure out how much we allocate to this, right, we're just going to do the 45% times the 900, copy it down on there. So it's going to be land at 270 there, building A at 405, building B at 225. In other words, you add these guys up, right? We're at 900 bucks, what we paid. So what's the deal on this, right? If we go back to the original question, right, we did the basket purchase, we paid 900 grand. You can't just do debit basket purchase. You got to do debit land 270, debit building B, right, BB for 225, debit building A for 405, right? That's how we break out the 900 bucks for it. We use the fair value, right? They give that to you and then you got to back into the percentage, multiply it over. There you go. You can call it a day. That's how we break out the $900. All right, let's look at 10.9 on this. So it says on January 1st, 2024, they purchased a tractor. They paid $5,000 down, and then they signed a non-interest bearing note requiring $25,000 to be paid in December 31st, 2026. So this must be, right, we're in 2024, 2025, 2026. So 3 years, right? So we pay $5K now, and then we sign a note payable that says, hey, in 3 years, we're going to pay $25K for this tractor. It says the fair value of the tractor is not determinable. An interest rate of 10% reflects the time value of money. The fiscal year end is December 31st. Okay, so they're saying here, for one, can you please prepare the journal entry to record the acquisition of the trailer, round computations to the nearest dollar. Okay, so let's think about this here. We know we started with cash, right? So we can credit cash for $5,000. Okay, always start with cash. That's the easiest. We know we also have a note payable, right? Credit note payable for $25,000. Here's where things get a little bit tricky, right? This 25 grand, right, that's in 3 years from now. So we got to shrink that down to the present value in order to value the tractor, right, on this case. So the tractor will be the 5 grand plus the present value of this 25 grand. So what we're going to do here, and it's not in the actual, the time value money tables aren't here, but if you were doing the homework or it was on the exam, they'd be given to you. But essentially, right, we have an N equals 3 we have an I, because it's 3 years, we have an I that equals 10 on there, right? If we were to get that present value factor of a lump sum, right, that would be 0.75131, right? So if we do 25,000 times that present value factor, right, we round it, right, it's going to be 18,783. Okay, so what's the deal? What do we got to go on here? We got to do debit tractor. In this case, it's a little bit, you got to think about it. It's going to equal $5,000, right, what we pay now, plus the present value of that note payable, 18,783, right? We're looking at 23,783. Hey, the difference here, right, because we got 23 and 30, that's going to be debit discount for 6217, right? That's kind of the journal entry here for 1, okay? Then for 2, it says, how much interest expense will the company include in its 2024 and 2025 financial statements? Okay, so we have essentially 2024 and we have 2025. How do we do this? Right, well, we have it on there, right? The note, right? If we present value the note, it's at 18,783, right? We shrunk it down to 18,783. We used a 10% discount factor there, so 10% because we're trying to build this thing up, right? We're looking at 1878 2024 interest. Okay, interest expense on there. That's great. Now for year 2, right, 2025. Well, it's going to be the 18,783 plus, right, that interest expense, we got to capitalize that as part of it, right, because we're building it up here, 1878 times 10%, right, we're looking at 2066 interest expense for year 2, okay? There we go. It's just like a little schedule. If you look at the PowerPoint, right, we looked at this. Then for 3, right, they're saying what amount of the liability the company will report on its 2024 and 2025 balance sheet. So they're talking about that note payable. Right, so for 2024, right, that note payable at face is going to be $25,000. But we're going to back out the discount of 6217 as well as the year 1 interest, right? So 6217 minus 1878, right? 25 minus the sum of that. We're looking at 2661 for end of 2024. For end of 2025, right, we have the $25,000 note. We got to back out, again, same thing, 6217, 1878. And then we also have that additional 2,066 of interest. All right, that's going to give you 22,727. Okay. 3 more problems here, nothing too bad. So it says the Tinsley Company exchanged land that it had been holding for future Plans expansion for a more suitable parcel of land. So it looks like they're trading land for land. And it's like old for new. All right, carried the land. So the original land had a cost of $30,000. It's currently worth $72,000. They also paid $14,000 in cash. All right, so we have the old land. Right, it has a book value of 30, and it has a fair value of 72. Right, we gave that land plus we gave cash of 14,000. Right, so we exchanged that. And what we got was the new land on there. And they aren't giving us really too much information for it, for the new land at least. All right, so a couple things here. First off, what is the fair value of the new parcel of land received? Right, so in this case, essentially what we're going to use here in order to get the fair value of the new is we're going to take, essentially in this case, as a general rule, we're going to assume there's commercial substance here. We're going to take the fair value of the old, 72, plus, the fair value of the cash, right? So 72 and 14, we're looking at 86 here. Okay, so that's one. Prepare the journal entry, assuming there is commercial substance. So what we would do in this case, let me use this guy right here, right? So that was 1, 2, right? We're gonna do debit land new for the 86,000, right? Because we have commercial substance on there. We're gonna credit, right? So that's like step 1, if you remember from the PowerPoint. Step 2, we're gonna get the old land off the books, right? So credit land old, right? We got to get that off the books for 30. We also gave some cash, right? So credit cash for 14. And then the difference here, right? We got to plug this. It's going to be a gain, right? So we're going to credit gain in this case for, you run the numbers on it, 42. Okay, that was 2. Three says, prepare the journal entry, right? So what we did here essentially, under 2 was commercial substance. We used the fair value of the old. Here for 3, it says, prepare the journal entry assuming it lacks commercial substance. What we're going to use is the book value of the old. So for 3, right, what we're going to do here is, right, we're going to do debit land, right, new. And in this case, right, we're going to take the 30, right, that's the carrying value, and then 14. The carrying value of the cash and the fair value of the cash is the same. It's different for the land, right? So 30 plus the 14, right, that gets us to 44, right? We're using the old. Then we'll get the old land, right? So credit land old. We got to get that guy off the books for 30. and then we're going to credit cash for 14. I mean, the other thing you could do is just get it off the books, credit cash, and then you could plug this guy right here. Okay, that was 3. 4, we're going to skip. It's a little bit complicated. It's not too hard, but 4 isn't going to be on the exam, but I like this kind of 1, 2, 3 simple examples there. Hey, first one, it has commercial substance. This is based on the fair value, right? So commercial substance. We're going to use the fair value. If it lacks commercial substance, right, as a general rule, we're going to use the book value. Right? So fair value if it has commercial substance, book value if it lacks commercial substance. Okay. All right, 2 more problems and we can button this thing up. Right, on January 1st, they began construction on a new facility, okay, a building. All right, it was completed in 2025. The only interest-bearing debt the company had outstanding during 2024 was a long-term bond with a book value of $10 million and an effective interest rate of 8%, right? So they got $10 million of other liabilities, and on that liabilities, there's an 8% interest rate. All right, it looks like we have some construction expenses here that happened throughout the year. They did not happen evenly, so we're going to have to kind of break these out and look at them, right? So if it happened in January, right, that was 12 months that were in the year that these kind of construction costs were floating out there. If it happened in March, right, that was 10 months. July, right, 5 months. These costs were floating out there, right? The remainder of the year, September 30th, 3 months, and December 31st, 0 months, right? That's right at the end of the year. What we gotta do is, right, we are going to do, right, so we got the January, we got March, we got July, we got September, and we got December. And this is all at the end of the month, okay? We're gonna take, right, the expenses with it. So it's 500, 600, 480, 600, 300. And what we will do is, right, we will divide this number, how many months it's been kind of floating out there, divided by 12, right? So 12 divided by 12. Oh, of course, right, 12 divided by 12. No, I don't want that. I want 1. All right, so I think because it's doing this, all right, so let me do here, 12 equals 10 divided by 12. Okay, we got it there. And so this one's 1. That might be because it's formatted for date. All right, so 12. All right, there we go. All right, we're just snagging these numbers. Equals 5 divided by 12. Equals 3 divided by 12. Equals 0 divided by 12. Right, that's kind of the idea there with those, right? And then we're just going to multiply it across, right? 500 times 100%, 500, carry that down, right? We then are going to sum all of those costs, right? We're looking at 1350 there of, these costs whenever we kind of figure out this like time weighted average, kind of the idea how long they've been floating out, right? 1350. To figure out the interest we capitalize, right? Because it seems like we've almost been going on a side quest here. The interest capitalized, right? What we're going to do is the 1350 times the 8%, right? So we'll do the 1350 times the 8%, right, on our other debt. Right, we're looking at 108 of interest capitalized. In other words, if you're trying to think of like big picture here, hey, we're building a building, right? Here we start here, we have some expenses in between all there, right? Here we are at the end of the year, right? Whenever we look at that building, it's going to be essentially the combination of the expenses we incurred plus 108 of interest, right? The combo of that will be kind of what we put that on there on the balance sheet for. All right, one last problem here. So we have Delaware Company. They incurred the following R&D costs during 2024. Salaries for wages and lab expenses, materials, purchase of equipment, fees paid to third parties for R&D expense projects, patent filing and legal costs for a developed product, and then salary, wages, and supplies for R&D work performed for another company. So that one's going to be a little bit tricky there at the end. What they know here, right, the equipment has a 7-year life and it will be used for a number of research projects. Okay, so these guys are going to be the outliers, kind of the green one there in the blue one. All right. So if we were to, it says calculate the amount of research and development expense that they should report in 2024, right? Well, imagine, right, we're Pfizer, right? We're working on, a new vaccine for COVID, right? COVID 2.0, right? All of those costs really until we develop that vaccine and it has commercial production, we're going to expense. So, hey, the salaries of our wages for our kind of lab employees, right? That's going to go in there. The materials, right, that we used. The fees that we paid for the R&D project on there with it. We also will have in this, a thing we got to be aware of is some type of depreciation related to this equipment. So we'll come to that. So with this, right, let's kind of sum this for where it is right now, right? We're trying to figure out R&D, right? So we will have 400,000 for, we'll just put salaries. We'll put 200,000 for materials. We'll put 320,000 for fees. Now we have to kind of analyze these other remaining items, right? We have a patent that's going to be a separate asset. We'll talk about it. So maybe I'll make that one, yellow, right? Anything we have highlighted here is going to have kind of special treatment. So let's unpack these one by one. The equipment, in this case, 7-year life in a number of research projects. So if you go back to the PowerPoint, we said whenever the R&D, the stuff we buy for it, it has like alternative uses. If it's like, COVID that we're trying to figure out, plus we're going to use, equipment to help us like find a cure for cancer, that has multiple uses, right? So what that then means is if we have the equipment for 900,000 and it has a 7-year life on it. So is it, purchase of equipment, 900,000. It has a 7-year life. And I guess they're not depreciating it, straight line in the sense I'm kind of jumping ahead of it here. Why can't I delete this? There we go. What they tell us is there's depreciation of 120,000. Right, so this equipment, right, that's great, 900,000, it's for multiple items. You don't expense the entire thing, right? In other words, you're going to do debit equipment, credit cash, whatever we pay. Thereafter, right, so just to kind of mirror the PowerPoint, journal entry 1 would be debit equipment, credit cash. And then journal entry 2 would be, right? We're going to do the depreciation expense, but essentially you do R&D instead of depreciation as the expense, R&D expense. That's kind of a trick there for 120. And we're going to credit accumulated depreciation for 120. So this guy, this 120, this comes up here, right? The $120,000. That's going to be depreciation on the R&D equipment. Now I'm just going to put alternative use, right? These other things, they don't have an alternative use. We're just using it for the COVID vaccine. This one, right, we're using it for COVID and trying to find the cure for cancer, right? So we're going to have to kind of match and allocate that there accordingly, based on the rules, okay? That's going to get us, right, if we sum that there, of $1,040,000 total R&D expenses, okay? But the question becomes like, all right, we talked about the green ones. We said they're special. The equipment has alternative use. We talked about that. The patent fees, right, and legal costs, these are going to be capitalized, right? In other words, they're part of the patent, right? So if you look at, the PowerPoint for this, it's a similar example in there. So that's capitalized. And then this guy right here, the blue thing, this is like when we had the PowerPoint when we said, okay, we're not working directly for Pfizer, right? It's not like here's Pfizer and we're, directly here kind of, doing the R&D as an employee of Pfizer. Instead, what's going on here is we have Pfizer who then hires us, a whole separate company, right? New company to do the R&D. Right, in those situations, right, like this guy right here, where we're performing R&D for another company, right, we're doing R&D for Pfizer, right, those costs are going to be capitalized and essentially become part of inventory and then expensed as cost of goods sold when revenue is recognized at the completion of the contract or as revenue is recognized over the life of the contract based on the percentage of completion. Okay, so nothing too hard there, just some examples, right? Take it slow, unpack it. It's just a lot of what we did in the PowerPoint, but with different kind of iterations and things like that. So I will end the lecture here.